Matthias Smith, founder and owner of Pioneer Capital Advisory. I lead a team of 6 people, 7 including myself. And what we do at Pioneer is we help people that are buying businesses with going through the small business financing process. So just like you, Ryan, I'm actually based in Madison, Wisconsin. So same city, have cool connection. And so I started Pioneer 3 years ago. We've helped 98 business buyers go through the SBA financing process in industries from e-commerce to HVAC, auto collision, everything across the board. And so essentially what we do is instead of having to go to banks on your own as a buyer, we help you with finding what banks are going to ultimately be the best fit for your deal by structuring the deal into a credit deck that shows sources and uses, cash flow analysis, background yourself, background the business, the combination of why the two make sense, and then basically helping you go through the process from start to finish with our team of analysts, my chief operating officer, Valerie, and basically providing a smooth journey from A to B. And then we're ultimately paid by the bank at the very end of the process after closing, so not by you as a buyer. Derek and Carlos, I'll turn it over to you guys.
Yeah, sure. So I'm Derek Ripp. I'm one of the partners with Austin Wealth Management. Kevin Smith is the founding partner and my business partner. And we are an independent fee-based financial planning wealth advisory firm. So we're committed to providing objective advice and personalized strategies to help our clients build, manage, and protect their wealth. And I specifically have been in business for about the past just under 30 years. I'm a certified financial planner, but also a certified exit planning advisor, which is really my focus. Now with clients or work a lot with almost specifically with business owners and helping them to incorporate that business as an asset into their overall retirement plan. And so, I felt that was a really important area that was unfortunately neglected in our industry, where a lot of advisors are focused on selling either investments or insurance products, whereas our business owners, it's very typical where a high percentage of net worth, 80% or more, is in the company. So again, our focus is on how to incorporate that business into as an asset into the overall financial and retirement plan. But planning is really our trademark and our focus. So I think you'll see that as a common theme that as we talk about how we work with clients and kind of the presentation today.
Awesome. So just kind of getting started here. So this is just the kind of index key that we're going to cover. So overview on Austin Wealth Management, who they are, what they do, overview on Pioneer, and then kind of going through different layers of important prongs of things that are important for you as a business owner or acquisition entrepreneur, hopefully to be a business owner with thinking about that ultimately goes into the journey of operating a business and effectively planning. So just to kind of kick things off, Derek or Carlos, if one of you wants to take this slide here.
Yeah. I'll jump in here. I would just, this is a kind of an expansion of what we were just talking about a moment ago, but I think a key differential is that while most advisors will focus on either the personal finance side of the equation or business consulting, we bridge both worlds. So our goal is essentially to turn complexity into clarity. And we want to help our owners, align both the business goals with their personal wealth. And the way that we do that is through the implementation of financial systems, of which are listed on this slide here. And we'll touch on a few of them today as well. But we believe that while every client is unique and we approach them with customized recommendations, that there are core financial principles that really apply universally. And so our structured approach delivers consistency and long-term results, all while preserving the personalization that every client deserves. So that's kind of it on that slide, Matthias.
Awesome.
Yeah, I once had a business owner jokingly say that they were the most replaceable person in their company. And my response to that was, and that's what makes your business valuable. And I think the takeaway, and what I want to get across in this slide is that, every successful business has a great team. So a visionary founder can set the direction, but really it's the team that brings that strategy to life. And so at Austin Wealth Management, we take a collaborative, team-based approach where we have structured specialized divisions. We have lead advisors, we have a financial planning division, client service division, an investment management division, and Carlos leads up our business development area. So that just allows us to have that continuity and expertise for our clients, and that's important for our clients, and many extend across multiple generations. Next slide, Matthias.
Yep.
I'll hand it back to you. I think that's you get a couple here.
Yeah. Yeah. So I guess just before Kev popping into the slide, so definitely, Derek, great call out on, a team is what ultimately makes a business valuable. And that's something that I myself, having started a company, have learned over the last 3 years is going from one person to multiple people. That's where you truly build value. And I think that's something where any business owner or acquirer, the more human capital infrastructure you have and the more of a team, when you're thinking about selling a business down the road, that's going to add a lot of value for you. So Pioneer Capital Advisory, we are a national commercial loan brokerage firm that's really currently specialized in the SBA 7A lending program. So essentially, the SBA 7A lending program is the SBA or U.S. Small Business Administration's flagship lending program that provides financing or backs commercial banks that are providing financing for acquisition entrepreneurs that want to go out and buy small to medium-sized businesses. Within that subset of lending in the SBA 7A loan program, the fairway that we've chosen to specialize in is financings between $1 to $5 million. And so those are ones where we're going to have to take a bespoke start to finish process, helping from getting the term sheets from the banks and being intricately involved closely with the client from the start of underwriting all the way through to closing. On smaller deals where the client is kind of more fine with working directly or closely with the bank, we will help with getting the term sheets for those clients for financings where the loan amount or loan request is $500,000 or above. If the clients can find taking the process or baton from the term sheet and being involved with the bank all the way through to closing. So that's what we do. And so we're a team of 7 people. So it's myself. I started the company back in May of 2022. This is a picture that was taken a day after I was a little bit sleep deprived in Mexico City with my team, hence the bags under my eyes. So that's me here. This is Valerie Stash, my chief operating officer. She sits in Indianapolis, Indiana. So our backgrounds, both of the two of us, are working in the SBA space. We cross paths at a former bank called Byline Bank. Byline's based at the Chicago market. And so we've each worked in the SBA space for about a decade. So I can oversee corporate strategy, marketing, and sales efforts. She's very much kind of HR hat, lender relationships, overseeing a lot of the day-to-day operations of the business, and then also legal and some of those other operation adjacent spaces too. So we have 2 sales gentlemen that work with us, Rafael, who's based in Brazil, Alan, based in Monterrey, Mexico. They do both inbound and outbound sales and origination efforts. So they'll take calls off of our website, searchfunder.com, LinkedIn, Twitter, and similar. And then we have 3 analysts or underwriters. So Pablo, who's our head of credit, his background is working at HSBC in their investment bank. He was at Deloitte as a consultant, and then most recently a boutique investment bank based out of Monterrey, Mexico. Fernanda, whose background is working in real estate private equity as an analyst. And then Ramiro, based in Buenos Aires, Argentina. His background's working at JP Morgan and their investment bank, and then also Argentina's equivalent of Doge. And so back to kept parlaying back to the slide that Derek presented, talking about his team at Austin Wealth Management. Having a team around me or kind of as part of the business has unlocked a lot of value. and made the client journey a lot better. But so this is our process here. So we get involved working on deals. Generally speaking, at the point in time a client is at or close to the signed letter of intent stage. So basically, when you have an opportunity that you're working on, you've come to terms with the seller on purchase price, seller financing if applicable. You have the broker listing, you have the financials for the business that you're going to buy, and basically you have a completed SBA personal financial statement, last 3 years of personal tax returns, something showing your credit score, resume, and kind of the general inputs on how you want to structure the deal. And so our process kicks off with an engagement letter that basically explains we are going to help you with going from start to finish through this financing process. So we're going to build a deck, or one of these analysts will build a deck, Pablo, Fernanda, or Romero, that will show the architecture of the loan request from the industry of what you're buying, background yourself professionally, background the business, why the two make sense, source and use, cash flow analysis. And then we pull a report from this firm called Lumos Data. Lumos is a financial SaaS software or firm that was founded by the former CFO of Live Oak Bank, this guy named Brett Keynes. And that basically shows what is the probability that's expected that your loan request will perform or default. So that goes in the deck too. The engagement letter also explains anything that gets sent to us gets kept confidential, only gets shared with the SBA banks that we work with, and then whoever you want to have access to the data room. So your attorney, financial due diligence provider, potentially your business insurance agent, and similar. And then lastly, in the engagement letter, it has a 45-day exclusivity provision, which explains since we only ultimately get paid over here after you close, we can't afford to get involved in a deal if the client's also working with other lenders. If that's what the client wants to do, we wish them all the best of luck and success. But we basically kind of bear in the fruits of the deal ultimately closing. So once the engagement letter gets signed, we send an intake list of the inputs we ultimately need to kick off our deck building process. The deck takes about 2 to 3 days to spin up based on having all of the raw materials or inputs that we need. So the financials, broker listing, personal financial statement, all of that good stuff. Once the deck ultimately gets built, we pitch it out to banks based on the debt service coverage of the deal, the industry, the corresponding pocket of the credit spectrum that ultimately falls into. So is it a deal for the more conservative banks, the more middle-of-the-road credit appetite banks, or the more aggressive banks? And then this slide here is actually a little bit aged because we updated it more recently. The floor of the debt service coverage of deals that we'll ultimately take on is 1.25. So the SBA allows you to go down to 1.15 as a buyer, meaning if you have 15% cash flow over debt service, both debt service to the bank and the seller, that's allowable to finance under the terms of the SBA. Since the loan broker, loan consultant firm name ultimately goes into the SBA system and they keep track of what firms' deals perform and which ones don't, we've just made a business decision that we're going to have 1.25 be our floor, both because we don't want deals that we work on to sour, but also because we want people that we work with to succeed. So once you get the term sheet back as a client, before the underwriting process kicks off, the bank will want to get from you a 3-year financial projection with the first year broken out monthly with detailed expense and basically income assumptions. So are you planning to build a new website? Are you planning to do SEO? Are you planning to give out bonuses to the seller's employees to retain them? Things of that nature. And so once the business plan, once the financial projection are done, and then you have the other inputs that the bank needs to get underwriting started, the process there typically takes somewhere in the neighborhood of 3 to 4 weeks. And this is dependent on the bank, the time of year. So if it's end of month, end of quarter, how staffed is the bank? Is it the summer, people taking vacations, things of that nature? And so the first half of the underwriting process is typically going to be you as a client working closely with the bank to answer questions on business financials, the business plan. How are you thinking about operating? What are you planning to do differently than the seller? What does the human capital infrastructure of the team look like? Things of that nature. Once you're about halfway through underwriting, so this step five here, at that point, Valor and our team steps back into the equation and she puts together what she thinks the closing checklist from the bank will ultimately look like once you as a client get approved. And so that will basically entail anything from the purchase agreement to the bank statements for the down payment, life insurance documentation, business insurance documentation, business licenses, things like that. And so she puts that together based on the signed letter of intent, the broker listing, and the term sheet or financing proposal from the bank. And so the goal is basically if you as a client are working on that list while you're in underwriting with her, that by the time you get approved, we have a bunch of stuff crossed off on that list so that you can close faster in that last stage of the journey. And so once you get approved by the bank issues a commitment letter. You'll get assigned a closer at the bank. They'll put a checklist together for you. And then once that checklist is fully complete, at that point, you can close. So Valerie also owns a step six on our team to basically help this part of the process go well. And we're currently actually in the process of hiring for someone to work under her just to help with managing capacity there. But I'll flip it back to you, Derek.
Before we jump to this slide, can you go back to the
Yeah.
last one?
Yep.
I was just
Let me.
curious, Matthias, have you ever run into a situation where this process was delayed because clients may have been financially unorganized or they don't have the data, in a spot that's easily accessible, and so they're kind of
Yeah.
scrambling for information. Does that ever happen?
Happens more often than you'd think or hope for. So a lot of the time, what I see happening is kind of one of two things. One is there's a lot of financial due diligence items that the seller either doesn't have and or their accountant is working to pull together before underwriting can kick off. So perhaps the year-to-date financials that were available before are a little bit aged. And so updated financials, P&L statement, balance sheet, things of that nature are needed to start the process. And or if it's a deal where the seller has run a lot of personal expenses through the company and they want to get credit for those personal expenses called add backs in the valuation of the business, the bank either wants to see the proof to validate that said expenses were personal in nature, and or they want to see some sort of financial due diligence from a third party accounting firm, a quality of earnings report or similar. Some banks are fine with that quality of earnings report getting done during the underwriting phase. Others aren't. It just depends on the bank and it depends on the extensiveness of what those add backs are. I don't know if that answers the question though.
Yeah, it does, and I appreciate you going back through that. I think that's consistent with when we talk with our clients about being financially organized, right? And that, yeah, you can transition to that next slide, I think, at this point too, where we're talking about beginning with the end in mind, essentially. And if the goal is to buy a business, wouldn't it be nice to actually have that data room built out, right? Where it's on the shelf, it's ready to go. Now you can proceed forward with that transaction. And that's the way that we like to approach in working with our clients is, understanding what are you trying to accomplish, right? And I think it was Zig Ziglar, I think he was a motivational business speaker. He said, "You can't hit a target you can't see." And there's a second part to that quote as well that I think is just as interesting. You can't see a target you don't have. So, combining those, what he's getting at is, understanding what you're trying to accomplish, and then having, setting those goals that are important to you, but then taking that big goal and basically, re-engineering it, right? So what are you trying to accomplish? And then break it down into pieces. So plan backwards. And then that's going to help understand what you need to do to execute day by day. What do you need to accomplish in 1 year, 3 years, 5 years, etc. And I think that's also important from a business exit standpoint. Here I know a lot of individuals you're working with, Matthias, are probably buying businesses, right? They're looking for financing for that.
Yep.
selling a business may be the last thing on their mind, right? But I would challenge even new buyers to approach this with begin with an end in mind mindset from the standpoint of what is your business worth today, and what could it be worth if it was run best in class? And essentially, what is it going to take to get there, right? So that's just good business strategy. Even if you don't plan on selling for a decade or more, you want to be in a position where your business is so well run that you could exit tomorrow. And again, that's a little maybe counterintuitive, but again, I think that fits under this mantra of begin with the end in mind.
Yeah, and I guess just two comments to pop back in there, Derek. So one thing, like when I'm working with clients or when my team's working with clients that are buying these companies and they're looking for SBA financing, the question or one of the top 3 to 5 questions the bank always asks is what does the seller do in the company? And the more the seller does, the longer the bank is going to want to see the transition agreement for how long the seller is going to stay on after the fact, because you
Hmm.
have to really be able to transition the metaphorical baton to the buyer, because otherwise things don't go well, the bank doesn't get paid, and things kind of spiral out. So that's thing number one. But then thing number two, and kind of counterintuitively, is as a business owner, you want to be the most dispensable person on the organizational chart in your team, because the
Hmm.
less that you have to do and the more other people are doing, the more enterprise value you've created, because the more transitional of a company you have.
Yep.
But yeah, let's just go to
Well,
all right.
well said. Yeah, I mean, and as a buyer, in addition to the bank, you want to make sure that the business isn't contingent on the seller, right? That there's systems, there's processes in place, that you're basically not buying a revenue stream that's going away when that business owner steps away. So great points there, Matthias. One of the systems that we work with our clients is cash management and liquidity. So, you know, cash flow is really the lifeline to any small business. And a lot of businesses fail, unfortunately, not because they're not profitable, but because that lack of liquidity management. And so they're cash flow deficient, right? And what we want to do is help our owners think through this liquidity process of how much cash should they have at any point in time. And there's a lot of variables that go into that. There's, from a business planning perspective, and managing working capital, also building personal reserves. And we look at both sides of the equation. Not having enough cash is a problem, but sitting on too much cash, it can be an issue as well. It's inefficient. A lot of times, our business owners, we see them or meet them when they're sitting on a lot of cash in a big bank. Pick your favorite big bank, none of them pay any interest, right? So what we're trying to do is help them think about, being more efficient and optimizing with that cash. And maybe it's just setting up another, corporate brokerage account to invest in treasuries, so incorporate some treasury management. So they're making, let's call it 4% or close to it on their cash. And it's liquid to where if they need it, they can always move it back into the main operating account. But that way, just trying to squeeze a little extra return out of cash. And again, what we want to do is we set these liquidity targets with our clients to make sure it makes it really straightforward in terms of how much should you have in checking, how much should you have in savings, how much should you have in an emergency reserve or a treasury account. And then that way, as a business owner, you can look down at your financial statement and quickly determine if there's enough cash or not. So,
Yeah, it's
um,
it's tough. I was actually super contemporary topic. I was actually just on a Teams or Zoom meeting earlier today with my banker, my accountant, my wealth guy, trying to suss out from my banker how much liquidity he wants to see in my operating account and how much, like, if I move some over to a money market with my wealth guy, if that's going to stir the hornet's nest when I want to refinance my business line of credit next year. So it's very super important stuff for sure.
yeah, and there's also some legal implications with that as well. So, there are businesses where you may not want to hold a lot of cash in it from a liability perspective. So sometimes it's transferring it out of the business into personal name, but still keeping it liquid and essentially minimal to no risk, so that it can be sent back to the business if needed. And if the business cash flow continues to grow, then eventually those personal assets can be converted into more longer term growth. So it's kind of a multiple step, process for some clients where they want to have that in between, like to be able to make a little bit more on my money, but I need it to be liquid. Or maybe I want it out of the business from a liability perspective and move it into my personal, but have the ability to have it liquid to send it back to the company if needed.
Yep, no, for
So,
sure.
so this slide is, when we talk about business or retirement planning, again, one of the things that is, a saying in the financial industry is concentrate to build wealth and diversify to protect it. And obviously, in the early years for any business, it's important to invest back in the company, to, fuel growth, build infrastructure, improve the sustainability of the business. And then I think, at some point it's as the company matures and becomes more profitable, then it's natural to start thinking about taxes and what the tax burden is, and that's wise to start incorporating more tax advantage strategies into or tax mitigation strategies into the overall plan. A lot of times those strategies can align with employee benefits or other retention goals. So things like setting up a 401(k) plan, or other tax advantage plans. And when it comes to retirement plans, the design is really important too. It's not as easy as just taking a retirement plan off the shelf. I like to call it, where you have a payroll company and they offer a 401(k), so you just implement their 401(k). A lot of times those plans don't work if an owner hasn't been thoughtful about how to design it. And so it's always understanding what that owner is trying to accomplish. And then yes, there has to be benefit for the employees. You can't discriminate, but there are legal ways to really design it in a way that most of that benefit can be shifted towards the owner. So when we're designing plans for our owners, a lot of times they will receive up to 80% of the benefit, which is a great deal for them. It's a good deal for their employees, and at the end of the day, they pay less in taxes, which most owners are pleased with that result. So so again, that's the tax piece of it. But as I was saying earlier on the front end of the conversation, for a lot of owners, their business is 80% plus of their total net worth. And so it's critical to start incorporating other diversification strategies, as that business has continued to grow, so that you can preserve and have that sustainable retirement income over time. And again, so sometimes businesses can be successful, and then owners can maybe overstay their welcome, or the market shifts, or there's disruptors that come into play. And so like I said, we believe in funding that business early on when it's needed, but later on, as the business starts maturing, we're in favor of that owner, creating some diversification of income streams, so they're not solely dependent on just the exit of that business down the road.
Yeah, and one comment to pop in here, and again, I'm not the wealth planning strategist like either of the two of you, Derek or Carlos, but just from my own experience with this, is you can do some creative things with like profit sharing stuff separate from the
Hmm.
401(k), where back to the comment, like the off the shelf payroll company 401(k) plan, it might not give you the benefit that you're really looking for, aside from the allocation of like who it benefits, if it's you, the employees, or whatnot. But yeah, there's definitely some benefits to really researching these with qualified folks that understand them well. Um,
Probably, oh, sorry to
oh,
interrupt.
sorry.
Probably the most common mistake that we see is when owners try to take a plan off the shelf, and they're probably thinking, well, I just want to offer a plan to the employees, but I don't want to necessarily provide a financial commitment. And if there's no incentive for the employees, a lot of times they won't participate. And if the rank and file, so to speak, don't participate in the plan, then the owner, the highly compensated individual or individuals, aren't able to put as much away because there are compliance rules in effect. And so it really doesn't work if they haven't thought through. And again, that's where we would say you want to make sure that you have a budget to contribute towards the employees in the form of some sort of match or safe harbor
Yeah.
contributions. There's ways to vest that, right? And same thing with profit sharing. Profit sharing is great because you don't have to do it every year, but you can if the business is profitable. But a lot of times we're vesting that contribution over 6 years. So that does a couple things. One, it minimizes employee turnover because employees generally don't want to leave money on the table. So it's a great, golden handcuff for the employees. And if they do leave and not all that money is vested, the money just stays in the company in this what's called a non-forfeiture account. So it's applied towards future employee contributions down the road.
Yeah.
But again, that design piece is really, really critical, and making sure that you're working with a firm that can help you do that properly.
Awesome. So, okay, next we have risk management, the 5 Ds: death, disability, divorce, disagreement, distress.
Yeah.
Yeah.
So really this is an important and often overlooked step, which is, protecting the value of the business that you've worked hard to build. So, I would say ask yourself, do you have a documented plan in place for these unexpected events? What do you want for your family, your management team, your ownership group if something happens to you? Do you have an operating agreement where it details out what's going to happen in these if these events occur? And a lot of times, if owners have been that thoughtful and not, a lot of times we meet owners and they haven't really given much thought to these things because they're not always the funnest topics to think about. But even for those that have some language that speak to this in the operating agreement, the next thing to think about is, how are they funded, right? Is this gonna be if because a lot of times, the owners, if there's an owner that if there's a partnership, let's say, and one owner passes on, it's not necessarily that the other owner's sitting on a few $1 million to buy out that deceased owner's shares. So what is the funding mechanism? How's the business value? These are all things that you want to think through. And then, there are things about, kind of on the distress side of things, what insurance do you have in place, and are you protected against risks such as cybersecurity, property damage, supply chain disruption, losses of key employees. Those are all areas that are important to think through as you're protecting the value of the business.
Awesome. So next slide here. So I guess I'll cover a little bit just from my
Yeah.
perspective with business buying. So one thing that I see lots of people when they're looking at a company and their first time business buyer is they get really fixated on the assets of the business. So like, what's the equipment being purchased? What's the building? Things of that nature. But at the end of the day, when it comes to buying a business and like the valuation that the business valuation company, the SBA bank engages will come back with, much of it hinges on the actual intangible values. So what is creating the cash flow in this business? What's the true earnings mechanism? And how is that accounted for? So, Derek, I'll hand it back to you here.
Yeah, great points, Matthias. And I would just add that, a lot of people are a lot of CPAs are focused on the traditional accounting systems. And that's important, but it's really a lot of times it's the intangible assets, things like company culture, brand, systems, customer relationships that truly drive the business value. And sometimes up as high as 80% of the company's value is based on the intangible. So again, both of those are important, but seeing that the intangible can have such a high percentage of the value, it's critical to just understand and nurture those areas.
Awesome. All right. So, next slide here. Okay. Understanding exit options.
Yeah, and again, I realize that for the audience of buying might be buying businesses, this might be not something that's not even kind of top of mind for them, and it's way out in the future. But when it is time to transition out of your business, it's important to evaluate both internal and external option strategies, and each come with their own set of distinct benefits and risk and tax implications. And so, and the other thing to mention is that a lot of times the valuation multiples can vary significantly based upon the type of the transaction, who is the buyer? Is it a strategic acquirer versus a financial buyer or even an internal successor? So those are all things that are important to think through, and ideally, years in advance of the exit because, you know, things change, people come and go, and the sooner the better from a planning perspective to be able to make adjustments and course correct if needed. And the other last point I'll make here is that it's not always about getting the highest offer. So, sometimes it's about ensuring the longevity of the business. It might be about providing jobs and support your local community. So there are situations where owners could get a higher multiple, but choose maybe to transition internally where the multiple may not be as high, but it accomplishes those other objectives.
Yeah, and one comment to kind of sprinkle in here is generally what I've seen is management buyouts from a financing standpoint purely tend to have a lesser burden of friction to getting done versus a third party sale because you have someone within the company that knows the team, they know the organization, they know much of the ins and outs of the business. They might not know the financial side or similar, but you can always hire a fractional CFO or a qualified accountant. But if you have the optionality of positioning your business for both a management buyout or a third party sale, it gives you more options instead of just having it be a third party sale. So just to sprinkle that comment in. All right, back to you, Derek.
Yeah. So I like to say that business and investing are team sports, so it really requires coordination among multiple professionals. That could be legal, tax, financial, operational advisors. And part of the value that we're trying to provide for our clients is really coordinating this wealth advisory team to ensure that the right professional is brought in at the right time to help make informed strategic decisions. So again, there are a lot of different people that it's important to be included. And for the average business owner, it can be confusing when to talk to what person. And even just within the legal realm, there's different types of attorneys, and they're not all created equal, right? There's estate planning attorneys, there's business transaction attorneys, there's copyright and intellectual capital attorneys. So, finding the right person to bring in is part of the value that we want to provide. Sit on the same side of the table with our client as a fiduciary, work in their best interest, and help to coordinate this effort. So, and I know that Matthias, and when you were talking about earlier, having working with other professionals that can get clients ready for that business purchase, coming into the table with financial organization in place and documents in one spot that they can access quickly. It's just going to make life easier for all these different professionals.
Yeah, and on that same vein, or kind of along that same vein, one comment I guess just to mention, I think Ryan mentioned he's a business buyer researcher. I'm not sure about Jorge, who's here on this call too, but having a attorney and CPA on your team makes a world of difference. One mistake I've seen is business buyers that try to do too much themselves, and that actually counterintuitively slows things down and it just makes the process more challenging. So just to encourage that for anyone that listens to this webinar is making sure you have the right professionals on your recorder. I have not typically come across a growth consultant. That's a new one for me. But in any case,
Yeah, and just to expand on that growth consultant, people call them different things. That could be just a business operational consultant. It's a lot of times that person that goes into the company and really works with the owner on the intangible areas that we were covering. What it's basically, it's working with that owner, say, what are your top three priorities? And they create a plan to execute to improve that. So, what we're trying to do at Awesome Wealth Management is coordinate, help create this master plan, if you will. Talking about all these things that we cover today, but we're not going to be that operational consultant or that growth consultant. We're going to partner with and bring in those types of people that they live, sitting in the businesses with their owners, or that is really their focus and skill set.
Got it. Got it. Well, yeah, just wrapping up here. So this is Carlos' contact information.
Yeah. So, and Carlos, I'll let you, introduce yourself here in a moment, but I would just say that if anything that we talked about resonates with you today, or if you're interested in learning more about our planning process, please reach out to Carlos. Carlos, runs our business development, and would love to have a complimentary call. But Carlos, if you don't mind, maybe just share a little bit about yourself and and how you work with our clients as well.
Yeah, absolutely. Thank you for the introduction, Derek. You pretty much said everything I think that needs to be said. Yes, I'm head of business development here, so I really sort of manage relationships on the very, very front end with all clients. So as you come on board or think about coming on board, we're just going to have a conversation, see if the value that we can add to you really makes sense. And if so, then I will assign you to one of our advisors or one of our planners, and we'll get you on the right path. So this QR code is active. You can also just send me an email, carlos at austinwealthmgmt.com, and here to help.